Hey everyone, before we dive in, here's something really cool. You're listening to an episode created almost entirely by AI. From the script to the voice, this is part of the AI Takeover series by Blockchain DXB, where we explore what's possible when humans hand over the mic to machines. There's little to no human involvement, and that's what makes this episode so powerful. Welcome to the future of content creation. Let's get into it. This episode is powered by Amana, the region's first and fastest growing regulated all-in-one trading and investing app. Whether you're looking to invest in US stocks like Apple or Tesla, or MENA giants like Adinoc or Salik, Amana puts the financial market at your fingertips. You also get access to gold, foreign exchange, ETFs, futures, and commodities. With over 375 assets to choose from, they've got the largest crypto selection in the region. And listen, guys, if you want to build long-term wealth without thinking about it every day and want to automate your investing, just set your monthly budget, choose your preferred categories, and let Amana do the rest. No fees, no lockups, and 100% customizable. Even better, funding your account is frictionless, and funding your account is easier than ever. You can fund your account with Apple Pay, Google Pay, credit cards, instant bank deposits, and even your crypto wallet. No friction, no hassle. And if you get stuck, Amana offers 24/6 real human customer support and personalized sales assistance. Because you're part of the Blockchain DXB community, you get an exclusive offer. Register with the code BlockchainDXB and make at least one trade to receive a $100 trading bonus credited to your account the following month. So what are you waiting for? Download the Amana app now. The link and code are in the show notes. Next up, Blockchain DXB is proud to be the official media partner for one of the biggest blockchain events of the year, the Blockchain Futurist Conference. For the first time ever, North America's leading crypto event is heading to the United States, taking place at the iconic Guitar Hotel at Hard Rock in Hollywood, Florida. Alongside it is ETH Women, happening simultaneously. Expect multi-stage panels, NFT galleries, DeFi showcases, tech demos, metaverse experiences, and more, all under one roof. It's where the smartest minds in blockchain, crypto, and AI will converge. Get 25% off tickets by using the code DXB25. And yes, I'll be there with exclusive live coverage, behind-the-scenes interviews, and spotlight features on groundbreaking projects. Mark your calendars, November 5th and 6th, 2025. Visit futuristconference.com and use code DXB25. Link is in the show notes. Next up, Blockchain DXB has two more interesting partnership news to announce. First up, with Future Blockchain Summit and Fintech Surge 2025. Blockchain DXB is an official media partner of Future Blockchain Summit and Fintech Surge 2025. Future Blockchain Summit is one of the biggest and oldest blockchain summit taking place in Dubai, going back to almost a decade, 2017 to be precise. The event takes place between October 12th to 15th at Dubai Harbour. This is where blockchain meets fintech to redefine the future of finance. 250 plus world-class speakers, 1,200 plus investors, live demos, product launches, and the exclusive invite-only GITEX Digital Assets Forum, all under one roof. From Web3 pioneers to fintech leaders shaping payments, banking, insurtech, AI, and DeFi, this event brings the entire ecosystem together. Startups, this is your launchpad. Get in front of top VCs, accelerators, and industry leaders. For blockchain and fintech companies, this is where connections turn into partnerships and dreams turn into exits. Register today at futureblockchainsummit.com. Don't just watch the future unfold, own your space in it. Remember, Future Blockchain Summit and Fintech Surge 2025. The registration link is in the show notes below, and see you at Dubai Harbour. Second partnership news kicking off from today is with the leading Bitcoin event organizers on this planet. And this year, Bitcoin Asia is taking things to another level. Bitcoin Asia are hosting a massive gathering this August in Hong Kong, and Blockchain DXB is proud to be an official media partner of Bitcoin Asia 2025. Taking place this August in Hong Kong, Bitcoin Asia is the region's premier Bitcoin gathering, where builders, investors, and innovators meet. It's really an honor for Blockchain DXB to be associated with Bitcoin Asia. Now at this event, expect powerful keynotes, bold conversations, and a headlining session with none other than Eric Trump. He will be sharing his vision for Bitcoin's long-term potential, its role in global finance, and Asia's massive impact on adoption, and a lot more. So listen up, guys. From infrastructure to regulation, privacy tools to lightning development, Bitcoin Asia connects global Bitcoin communities and drives innovation across cultures and markets. And as part of this partnership, you can register for the Bitcoin Asia using the code DXB. All the details are in the show notes below. If Bitcoin's in your blood, this is your event. So, register today at asia.btc and don't forget to use code DXB for 10% off your tickets. Bitcoin Asia 2025, Hong Kong is calling. Be part of the future of Bitcoin. Next up, Advanced Media is the largest distributor of professional video, photography, cinema, and broadcast accessories in the Middle East. They represent over 100 major brands, including DJI, Hasselblad, Red, and Rode. The mic I'm using to record this? Sponsored by Advanced Media. But what really sets them apart is their commitment to purpose. People, planet, and prosperity. That's not just branding, it's their actual business model. They've partnered with SAE Institute in Dubai to offer scholarships to students pursuing a bachelor's degree in filmmaking, each worth AED 50,000. They also run regular workshops, training programs, and tech showcases across the region. For more info, visit amt.t, that's amt.tv. Finally, let's talk about something every crypto investor should take seriously: security. And that's where Ledger comes in. Ledger is one of the most trusted names in crypto security. Their hardware wallets, like the Nano S Plus and Nano X, keep your assets safe by storing your private keys offline. That means you're protected against hacks, malware, and phishing attempts that can compromise online wallets. The company is headquartered in Paris and is constantly innovating. Their team works with world-class security researchers and regularly tests their own products for vulnerabilities. It's why Ledger wallets are used by millions around the world. Using a hardware wallet isn't just smart, it's essential. If you're serious about crypto, it's time to stop relying on centralized exchanges or browser wallets. Click the link in the show notes to order your Ledger wallet and support this podcast at the same time.
Welcome to the Deep Dive. We've got a remarkably dense stack of material today. It's a briefing from Blockchain DXB dated March 4th, 2026.
Yeah, dense is definitely the right word for it. It's massive.
Right. It covers everything from, global market panics and hidden Senate riders,
right,
all the way down to the really granular mechanics of stablecoin audits. And the overarching themes staring us in the face today is this intense tension between control and chaos.
Exactly. You have governments desperately trying to maintain control over their fiscal infrastructure, while the market is just, simultaneously reacting to the chaos of a major geopolitical conflict.
And you, sitting right there listening to us, you are the vital third person in this conversation today. Our mission is to connect these dots with you and figure out what the underlying data is actually trying to tell us about the future of global liquidity.
It's a fascinating snapshot of a financial system in transition. I mean, the data points we're looking at today aren't just numbers on a screen. They're behavioral signals.
Yeah, they show us exactly how institutional capital, and retail users too, are attempting to navigate a landscape where the traditional rules of finance are just being rewritten in real time.
But before we get into the weeds of all that market data, we really need to set a hard ground rule for this discussion.
I'm glad you brought that up.
Okay.
Because the DXB briefing we are unpacking today contains explicitly politically charged content. It details strategic updates and market reactions, specifically regarding the Trump administration, an ongoing geopolitical military event that the sources refer to as Operation Epic Fury, and directives involving cabinet members like Secretary of Defense Pete Hegseth and Secretary of State Marco Rubio.
Right, and we need to be very clear about our role here.
Exactly. I want to be entirely clear with you, the listener. In this deep dive, neither of us is taking any political sides, none whatsoever. We are impartially reporting the facts, the data points, and the market reactions exactly as they are presented in the source material.
Yeah, we aren't endorsing, supporting, or validating any of the policies, viewpoints, or figures mentioned. Our only job is to look at the math, to analyze the financial and technological ripples.
The goal is simply to observe the chessboard. We're looking at how macroeconomic events trigger specific capital flows, entirely regardless of the political origins of those events.
And right now, the way that capital is flowing is it's actively defying a lot of legacy financial models.
Okay, let's unpack this because the core paradox in the data is just jarring. We are in a scenario where the broader market is flashing red. Geopolitical tensions are peaking with Operation Epic Fury, and the immediate reflex across the globe is, naturally, traditional risk-off sentiment.
Which is what you'd expect.
Right. But hidden inside this massive wave of fear, we're seeing billions of dollars suddenly flowing into the exact digital assets that conventional wisdom dictates you should completely abandon during a global crisis.
It really forces us to reevaluate market psychology. I mean, the briefing drops us right into the middle of this Operation Epic Fury, and the immediate guidance provided by the analysts at DXB is to monitor the situation through very specific direct channels.
Yeah, they point directly to the White House press office, President Trump's direct communications, and the updates from Defense Secretary Hegseth and Secretary of State Rubio.
Because the market isn't looking for secondary analysis right now. It is aggressively seeking primary source clarity so it can model its risk.
And the initial market reaction, to be fair, made total sense. The textbooks tell us that when the drums of war start beating, capital flees to the ultimate baseline of perceived safety, which historically has been the U.S. dollar.
And we saw exactly that. The dollar index surged to a near 2-month high.
And when the dollar flexes, it naturally suppresses risk assets. Equities take a hit, and we saw the crypto market take a really violent, immediate blow. Bitcoin dropped sharply from $70,000 down to $66,500.
That is a classic algorithmic risk-off rotation. When institutional allocators are looking at a sudden, unknown geopolitical variable, they just reduce their exposure to high-beta volatile assets to protect their downside.
But the plot twist happens in the subsequent 24 hours. The narrative didn't just stabilize, it aggressively inverted. Global crypto market capitalization snapped right back to $2.41 trillion.
Right, and Bitcoin rebounded to $68,346. The total cryptocurrency market volume just swelled to $125 billion.
But here is the data point that creates the massive paradox. You have this V-shaped recovery in price and volume, yet the fear and greed index for the crypto market is currently sitting at a score of 20.
20, which is extreme fear.
Exactly. A score of 20 is the literal definition of extreme fear. So the broader market sentiment is terrified, but simultaneously, the briefing highlights an astonishing $513.7 million in crypto ETF inflows over just the last 24 hours.
That $500 million rushing into ETFs while the fear gauge is at 20, that is the defining behavioral metric of this entire geopolitical event.
Wait, but think about that. If we're at a 20 on the fear index, who's actually deploying $500 million, that doesn't track. If allocators are terrified, they don't buy the dip on the most volatile asset class on Earth.
They do if they're buying clarity rather than buying the asset itself. The source material features a really sharp analysis of this from a market commentator named Satoshi.
What was their take?
Basically, the initial drop to $66,500, that was the market pricing in the unknown. Uncertainty forces a worst-case scenario pricing model. You assume the worst because you don't know the parameters.
Right.
But as the administration, through Hegseth, Rubio, and the White House channels, began providing constant, transparent updates on Operation Epic Fury, the actual parameters of the conflict became defined.
So the market wasn't necessarily celebrating the news. It was just relieved that the scope of the news was finally measurable.
Exactly. Markets can price in bad news all day long. What they absolutely cannot price in is an unquantifiable variable. Once institutional capital felt they understood the ceiling of the geopolitical risk, that $513.7 million sitting on the sidelines rushed back in.
Wow. So that ETF inflow represents the premium that investors are willing to pay for a defined risk horizon.
Yes. They aren't saying the world is perfectly safe. They are saying we now know exactly how dangerous it is, and we can model our portfolios around it.
Which completely upends the traditional definition of risk-on versus risk-off assets. If you look at how Bitcoin is acting here, it's having a massive identity crisis. I mean, the original thesis was that Bitcoin is digital gold, right? A decentralized asset, entirely detached from sovereign conflict.
Right.
But it initially dumped alongside tech stocks like a standard risk-on asset, only to violently pivot a day later and catch bids like a safe haven. It's straddling both worlds.
It's a total schizophrenia in the market's perception. The briefing notes the inverse relationship typically seen between the strengthening US dollar and Bitcoin. Usually a strong dollar just suffocates crypto.
Yeah, and gold, the legacy safe haven, usually holds or rises when the dollar flexes during a crisis.
Exactly. So the fact that Bitcoin initially correlated with tech equities on the way down, but then absorbed $500 million in ETF inflows once clarity was established, it suggests that institutional allocators still haven't reached a consensus on what role this asset actually plays in a macroeconomic storm.
And that identity crisis in the market is bleeding directly into the regulatory halls in Washington. Because while market is out there trying to figure out how to value decentralized money, the U.S. government is making very definitive moves to protect centralized money.
Yeah, the legislative side of this briefing is wild.
According to the stack, the U.S. Senate just advanced a bipartisan housing bill. But tucked deep inside this housing bill is a legislative rider that fundamentally alters the trajectory of American finance.
The CBDC ban?
Right. It imposes a strict ban on the Federal Reserve, preventing them from issuing a central bank digital currency, a digital dollar, until the year 2030.
The mechanics of Washington are always fascinating. You have this profound decision regarding the architecture of sovereign currency attached to a housing bill driven by House conservatives. But you have to look at the political momentum behind this rider,
Which the briefing outlines clearly.
Yeah, it explicitly points out that President Trump campaigned heavily on halting the development of a CBDC. And upon taking office, he reportedly signed an executive order on day one to implement that ban. The White House backing of this Senate rider is basically the legislative cementing of that executive action.
Now, to be fair to the timeline, the source also reminds us that Fed Chair Jerome Powell and other Federal Reserve officials had already stated they wouldn't issue a digital dollar without explicit congressional authorization anyway. They weren't exactly going rogue in a basement to build this thing.
Right. But this legislative lock-in, combined with the executive order, it changes the conversation. It goes from we are waiting for permission to we are legally prohibited from proceeding. If we connect this to the bigger picture, if we look at that control versus chaos theme, CBDC is the ultimate mechanism of financial control.
Oh, absolutely.
When we talk about a central bank digital currency, we aren't just talking about upgrading the banking software so your app runs faster. We are talking about programmable money. It's a structural shift where the central bank doesn't just manage the supply of money, they can theoretically manage the behavior of the money.
Let's ground that in reality for a second so you, the listener, understand why this obscure banking rule matters to you. If a government rolls out a programmable digital dollar, they could theoretically encode expiration dates into stimulus checks.
Yes, exactly.
Yeah, like if they need to boost the velocity of money in a recession, the code literally dictates that if you don't spend the money within 30 days, it vanishes from your wallet. Or they could use geographic fencing, restricting the funds so they can only be spent in specific jurisdictions or on specific categories of goods.
Which is precisely the philosophical clash the hosts of the briefing highlight. They draw a direct contrast between the architecture of a CBDC and the architecture of Bitcoin.
Night and day.
Completely. Bitcoin was engineered to be permissionless, open source, and borderless. There is no central authority that can unilaterally alter its monetary policy or censor a transaction. By aggressively banning the CBDC, the U.S. government is essentially drawing a line in the sand.
They are actively choosing to maintain the traditional two-tiered fiat banking system rather than evolving into a hyper-surveilled, programmable monetary model.
It's a very interesting defensive posture. They are watching the traditional dollar flex its strength globally amidst the geopolitical chaos of Operation Epic Fury, and they are choosing to protect that exact legacy structure.
And for advocates of decentralization, this rider is viewed as a massive victory. It means the U.S. dollar won't become this programmable monopoly that directly competes with the ethos of open source networks.
But the irony, and there is always irony in these markets, is that by abdicating the digital currency space at the state level, the U.S. government has created a massive vacuum. The demand for digital blockchain native dollars hasn't disappeared just because the Fed isn't issuing them.
Not at all.
That demand has just been entirely absorbed by the private sector.
And that brings us to the actual plumbing of the crypto economy. Stablecoins. The government might not be minting a digital dollar, but private entities are minting them to the tune of a $313 billion aggregate market cap.
That's the engine.
That is the engine. You can't have decentralized finance without these fiat-pegged tokens moving the liquidity around. Tether's USDT is the absolute leviathan in the room, with an $183.88 billion market cap and a staggering $96.37 billion in 24-hour trading volume. Circle's USDC trails at $76.4 billion.
Those numbers represent the baseline liquidity of the entire ecosystem. But the briefing takes a magnifying glass to a much newer, highly specific player in this space. Tether USA, trading under the ticker USAT.
Designed as a US-exclusive stablecoin.
Exactly. And the source material provides a really granular breakdown of its newly published reserve report.
Let's look at the actual math of this audit, because the specific numbers tell a very compelling story. The report was executed by Anchorage Digital Bank and independently examined by Deloitte, one of the Big Four legacy accounting firms.
They're big heavy hitters.
So as of the January 31st, 2026 snapshot, there were 17,501,391 USAt tokens in circulation. To back those tokens one-to-one with the US dollar, the reserve sat at $17,604,716. So, simple math, they have a surplus. The reserves exceed the outstanding tokens by exactly $103,325.
The presentation of this report is masterfully designed to project an aura of absolute institutional safety. I mean, they are heavily emphasizing the involvement of Deloitte, the use of regulated segregated accounts, and backing the tokens with cash and short-term U.S. Treasury reverse repurchase agreements. It's meant to look pristine.
Right.
But the analysts in the briefing do a fantastic job of peeling back that polished veneer to expose 5 critical structural vulnerabilities that exist within this specific setup.
Right. Because an audit isn't a magical shield against market mechanics.
Yeah.
Let's dig into these 5 dangers. Number 1 on the list is their heavy reliance on short-term U.S. Treasury-backed reverse repurchase agreements.
Yeah, reverse repos. In a low volatility environment, a reverse repo is as safe as it gets. You are essentially lending cash overnight in exchange for U.S. Treasuries as collateral.
Super standard TradFi move.
Very standard. But we aren't in a low volatility environment right now. We are dealing with the fallout of Operation Epic Fury. The danger here is a liquidity crunch. If a black swan event triggers widespread panic and thousands of USAt holders simultaneously demand to redeem their tokens for actual fiat dollars, Anchorage has to unwind those repo agreements rapidly.
And what if they can't?
Exactly. If the repo market seizes up or experiences severe friction, which has absolutely happened historically in traditional finance, they might not be able to liquidate the collateral fast enough to honor the redemptions.
It's the digital equivalent of a bank run. It really doesn't matter if the assets exist on a balance sheet somewhere. If you can't push them through the exit door fast enough to meet demand, the peg breaks.
Yep.
Okay, danger number 2 is focused on that surplus number we just talked about.
The $103,325 surplus. On paper, sure, it's a positive number, but in the context of institutional finance, it is microscopic.
It's a rounding error.
It's spare change. Think of a local bank branch. If the vault only has enough extra cash to cover one single customer closing out their checking account, the bank is technically solvent, but practically, it is a hair trigger away from insolvency. If the value of any of their underlying reserve assets experiences even a fractional downgrade, or if there are unexpected operational costs during a crisis,
And that 103K buffer vanishes instantly.
dropping the backing below the critical 1-to-1 ratio.
Which makes you realize how precarious the illusion of safety really is. You see the word surplus and you feel secure, without realizing the surplus is the equivalent of spare change in the couch cushions. Danger number 3 addresses the fundamental flaw of the audit format itself: the lag time.
This is a vital concept for anyone reading financial reports. The Deloitte examination is a static snapshot taken on January 31st, 2026. The briefing we are analyzing is dated March 4th. Over a month has passed.
A lifetime in crypto.
Truly a geologic era. In traditional equities, a month is a quarter of an earnings cycle. In crypto, an audit only validates what was safe on a specific Tuesday weeks ago. It provides absolutely zero guarantee about the state of the reserves right now, especially when the current market is reacting to a live military operation.
Wait, let me push back on that for a second. If they have $17.6 million in reserves backed primarily by U.S. Treasuries, isn't that the gold standard? Why should a retail investor really care about a month's lag time if the underlying asset is heavily government-backed? Treasuries don't just vanish into thin air.
No, the treasuries don't vanish, but the composition of the reserve can change. And the liquidity profile of those treasuries can fluctuate based on Fed rate decisions or macroeconomic shocks. A static audit doesn't tell you if they had to shift the weighting of their portfolio to handle redemptions between January 31st and March 4th. A snapshot is not a live attestation.
Fair point. It's a photograph, not a live feed. You can't trade on a photograph. Okay, danger number 4 gets into the actual blockchain plumbing. The report cites chain-owned liquidity and external risk oversight,
Which introduces platform and counterparty risk. The safety of the fiat sitting in an Anchorage bank account is completely irrelevant if the smart contract governing the USAT token on the blockchain contains a vulnerability.
Code is law until the code is broken.
Right. If the network experiences an exploit or the bridging mechanics fail, the digital representation of the dollar is compromised, regardless of how secure the physical dollar is in the vault.
And that leads directly into the 5th danger, the limits of insurance. The report heavily promotes that the funds are in segregated accounts.
It's a very comforting phrase, but segregated does not mean universally insured. In a traditional U.S. bank, your checking account is shielded by FDIC insurance up to a specific limit if the bank goes under. The briefing points out that the extent of comprehensive absolute insurance on these stablecoin reserve accounts in the event of institutional insolvency isn't always foolproof.
So if things go south,
If the custodian bank holding the segregated funds experiences a catastrophic failure, token holders might find themselves waiting in line during a bankruptcy proceeding rather than instantly getting their dollars back.
which perfectly frames a very specific question asked during the Source's AMA segment. A listener named Tanya wrote in and asked this exact thing. She said, with USAt reserves fully backed, do you feel safer holding USAt or other stablecoins during market volatility? The host broke this down by looking at the psychology of the investor's jurisdiction.
And that's the key. The brand power of the U.S. financial system is immense. For an American investor, seeing the Deloitte logo, knowing the reserves are in U.S.-regulated segregated accounts, and seeing the direct tie to U.S. treasuries, it provides a massive psychological safety net. They are actively seeking the regulatory perimeter of the United States to protect them from the volatility of the crypto market.
But the hosts, operating from outside the U.S., noted that this premium doesn't universally translate. USA has geographic and regulatory limitations.
Huge limitations.
Right. For a non-U.S. investor navigating the chaos of Operation Epic Fury, they might prefer the deep oceanic liquidity of a globally accessible stablecoin like standard USDT, despite its different audit structure, simply because they know they can move it across any international exchange at any time without facing U.S.-centric friction.
It comes down to what kind of risk you are trying to mitigate. Are you optimizing for regulatory compliance and audit prestige, or are you optimizing for absolute borderless liquidity? And that question of user friction and accessibility is the perfect bridge into the massive structural shift happening with decentralized exchanges right now.
Oh, man. The data on decentralized exchanges, or DAXs, provided in the briefing is a harsh reality check for the purists, the ones who believe the whole world is going to move entirely on-chain. Right now, the 24-hour trading volume for all DAXs combined is $9.78 billion. The total value locked across DeFi is $94.23 billion. But the critical metric is the dominance ratio. Decentralized exchanges only account for 20.34% of total exchange volume compared to their centralized counterparts.
And as the hosts point out, veterans in this space have been waiting for that number to hit 60 or 70% for years. The technology has been functional for a decade, the yields are often better, and it perfectly aligns with the core ethos of self-custody. Yet nearly 80% of the market volume still flows through centralized corporate entities.
Because the friction is simply too high. Let's be honest about the user experience of raw DeFi. To trade on a DX, you have to manage your own seed phrase, bridge assets across different networks, pay fluctuating gas fees, and interact directly with complex smart contracts.
It's exhausting for a normal person.
It's terrifying. For a retail user or even a traditional institutional allocator, the cognitive load and the fear of making a single catastrophic misclick is overwhelming. It's much easier to just log into a centralized exchange with an email and a password.
Which is exactly why the integration announced in the briefing is so pivotal. We are seeing a massive convergence between TradFi-style centralization and native DeFi mechanics. The major centralized exchange OKX has announced an integration with a platform called Katana.
And Katana is incubated by Polygon Labs and GSR, right?
Yes, GSR being a massive quantitative trading firm. What this integration does is abstract away all the terrifying plumbing of DeFi.
It allows OKX users to earn native on-chain DeFi yields without ever leaving the centralized platform. They don't need a self-custody wallet, they don't have to bridge tokens, and they don't have to worry about smart contract interaction. They just click a button on OKX and the exchange handles the complex routing on the back end.
And to sweeten the deal and drive adoption of this hybrid model, they are running aggressive incentives. OKX is giving away 65 million SEEK-EE tokens to users who deposit USDT by March 17th, 2026. It's a classic DeFi yield farming strategy, but it's being distributed through a purely centralized portal.
They've also layered in institutional risk oversight from firms like Gauntlet and Stakehouse Financial, right, to monitor the systemic risks of routing all this centralized capital into decentralized protocols.
Yeah, but, the head of Katana, Matthew Fisher, is quoted saying that centralized exchanges are becoming the primary distribution layer for DeFi yield. But we have to look at the systemic consequences of this. If OKX, Binance, and Coinbase become the primary routing layers for all decentralized yield, aren't we just perfectly recreating the legacy banking system?
That's the million-dollar question.
We are building a system where a handful of massive centralized entities hold all the capital and simply use the blockchain as a back-end accounting ledger.
It's the ultimate philosophical compromise. The purists argue that this defeats the entire purpose of crypto. If you're trusting OKX with your keys, you don't have censorship resistance, and you have counterparty risk. But pragmatists look at that 20.34% DEX dominance and realize that mass adoption will never happen if you force every user to be their own cybersecurity expert. Centralized abstraction is the price you pay for onboarding the next billion users.
It's the trade-off of control for convenience. Users are willing to give up the control of self-custody to avoid the chaos of managing their own private keys. And speaking of the aggressive pursuit of mass institutional adoption, the briefing shifts our focus geographically to the Middle East. Specifically Dubai, which is actively positioning itself as the regulatory and technological capital of this hybrid financial future.
Yeah, the DXB stack highlights two major events they are hosting, and the curriculum of these events provides a real roadmap for where the smart money is focusing. The first event, happening on March 21st, is called Bitcoin for Business. This isn't a conference about trading technicals. This is an institutional seminar on integrating Bitcoin directly into corporate treasuries.
And they are building the curriculum around the ultimate case study, Michael Saylor and MicroStrategy. Saylor essentially pioneered the concept of the Bitcoin standard for corporate balance sheets, converting his software company's treasury into a massive Bitcoin holding vehicle. The briefing focuses on the pain points that emerge when other companies try to replicate this strategy, especially in the current macro environment.
It's a logistical nightmare for a standard corporate CFO. Many smaller companies followed Saylor's playbook and allocated treasury funds to Bitcoin during previous bull runs. But now, with the extreme volatility triggered by events like Operation Epic Fury, they have to figure out how to explain wild balance sheet swings to their board of directors. A 10% drop in Bitcoin's price over a weekend can completely warp a company's quarterly earnings report.
Which is exactly why the Bitcoin for Business event is heavily weighting its focus toward macroeconomic indicators. Corporate treasuries aren't just looking at the Bitcoin chart. They have to understand how external forces like US CPI inflation data and Federal Reserve interest rate decisions are going to impact the value of their treasury.
Furthermore, the event is dedicating massive resources to UAE legal compliance.
That's the critical barrier to entry for institutions. They cannot operate in a gray area. The event focuses heavily on navigating anti-money laundering, or AML, and Know Your Customer, or KYC, obligations within the UAE framework. If a corporation in Dubai wants to hold Bitcoin on its balance sheet, they need absolute certainty that the liquidity they are interacting with is legally compliant and isn't tied to sanctioned entities. The Wild West era is dead. Institutional adoption requires intense regulatory friction.
Here's where it gets really interesting. The second event, scheduled for April 3rd, shifts from corporate treasuries to the absolute holy grail of blockchain technology right now, tokenization.
Oh, this is massive.
The event is titled Tokenization, Unlocking Real-World Assets with Blockchain. For context, real-world assets, or RWAs, involves taking a physical, tangible asset, whether it's a skyscraper, a piece of fine art, a fleet of cargo ships, or intellectual property, and issuing a digital token on a blockchain that legally represents fractional ownership of that asset.
Tokenization fundamentally restructures how value is transferred and managed globally. The DXB briefing dives into the debate over the underlying architecture required to make this work. The core question is, can you tokenize a real-world asset on a truly open, permissionless blockchain like Ethereum, Or does it inherently require a permissioned private blockchain controlled by a central authority?
Well, if you tokenize $1 million piece of real estate on a permissionless blockchain, anyone in the world with an internet connection can buy a fraction of it. But that immediately violates every KYC and AML law on the books because you have no idea who is buying the token.
Exactly, which is why the practical application happening in Dubai right now is heavily reliant on state entities. The briefing highlights the pioneering work being done by the Dubai Land Department in conjunction with VIR, the Virtual Asset Regulatory Authority. They are building the legal infrastructure required to establish secondary markets for tokenized real estate.
Let's break down why a secondary market for real estate is so revolutionary. Historically, real estate is burdened by a massive illiquidity discount. If you own an apartment building and need to raise cash, you can't just sell 10% of the building on a Tuesday. The transaction takes months of lawyers, escrow, and title transfers.
It's slow and painful.
But if that building is tokenized into 1,000 fractions on a legally compliant secondary market, you can list your fractional tokens on an exchange and execute a trade globally in milliseconds.
You are taking the most sluggish, paperwork-heavy asset class on the planet and injecting it with the liquidity velocity of the stock market. But to do that legally, the tokens have to be geofenced and programmed to only interact with wallets that have passed strict KYC checks approved by the Dubai Land Department. It's a perfect example of how the technology is being adapted to fit within traditional, centralized regulatory perimeters.
The infrastructure required to support all of these massive shifts from corporate treasuries to real estate tokenization, it's immense. And the source material gives us a glimpse into the health of that underlying infrastructure by looking at the perimeter data. We get some rapid-fire ecosystem metrics that act as vital community signals.
Let's look at the raw network data first. Beyond the Bitcoin volatility, the briefing notes Ethereum is sitting at $1,985 with a market cap of $239.52 billion. Binance's native chain token, BNB, is at $634. But the most alarming data point presented is a structural one. Over the last 2 weeks, there has been a significant digital asset treasury outflow of $296.64 million.
And the briefing specifies that this negative outflow is heavily concentrated in coins connected to proof-of-stake consensus mechanisms. It's actively causing validators to withdraw their staked assets.
We need to explain why validators withdrawing is a critical security metric. In a proof-of-stake network like Ethereum, the security of the blockchain is maintained by validators who lock up or stake their own capital as collateral to verify transactions. If they act maliciously, their capital is slashed. When you see nearly $300 million in outflows causing validators to withdraw, it's not just a metric of price action. It's the equivalent of security guards walking off the job at a digital vault.
The total value locked in the network acts as the security budget. As that value drops due to macroeconomic fear, the economic cost to attack the network theoretically lowers. It's a sign of tangible stress in the underlying architecture of these networks during times of geopolitical panic.
But juxtaposed against that technical on-chain stress, the briefing also highlights the vibrant physical ecosystem being built around this industry, specifically evidenced by the podcast's diverse list of sponsors. It's a really fascinating cross-section of how the technology is permeating traditional culture.
It really is.
Yeah.
You have Amana, an investing app that is aggressively pushing for frictionless retail onboarding by offering a $100 trading bonus. They're trying to lower the barrier to entry for the everyday user. Then you have the institutional and cultural blending represented by the Blockchain Futurist Conference. The fact that a massive blockchain summit is scheduled for November 2025 at the iconic Hard Rock Guitar Hotel in Florida shows how deeply intertwined this industry is becoming with mainstream entertainment and hospitality venues.
The cross-pollination gets even more specific with a sponsor like Advanced Media. This is a legacy distributor of high-end professional camera and broadcast equipment brands that supply traditional Hollywood and broadcast networks. The fact that a traditional tech hardware company is actively sponsoring Web3 content demonstrates recognition that the media power and the capital to fund that media is increasingly originating within the crypto ecosystem. They are following the attention economy.
But the most unexpected and arguably the most fascinating sponsor integration is the Race Podcast. This is a show entirely dedicated to the grueling world of obstacle course racing in the Middle East. Think Spartan races and Tough Mudders. But they aren't just talking about fitness. They are releasing a set of 7 distinct NFTs, with each digital token explicitly representing one of the 7 Emirates of the UAE.
It's the perfect synthesis of physical culture and digital identity. You have this intense physical sports community utilizing blockchain technology to create verifiable digital collectibles that represent national identity. It shows that a healthy ecosystem isn't solely defined by the spot price of Bitcoin or the volume of a DX. True viability requires a robust cultural periphery.
It needs the media infrastructure of an advanced media. It needs the community identity of an obstacle course NFT. And crucially, it needs the foundational security ethos promoted by their final sponsor, Ledger. Their classic mantra, not your keys, not your crypto, is the philosophical anchor that grounds everything we've discussed today.
It's the ultimate reminder of the control versus chaos dynamic. If you don't control the cryptographic keys to your assets, you are at the mercy of the institutions that do, whether that's a central bank issuing a digital dollar or a centralized exchange routing your DeFi yield.
What an incredibly dense, revealing journey this stack of information has taken us on. We started by dissecting the macroeconomic fear triggered by Operation Epic Fury, watching the paradox of $500 million flowing into crypto ETFs, not to buy the asset, but to buy clarity in a chaotic market. We explored the ideological battle lines being drawn in Washington, with the Senate push to ban the programmable central bank digital currency, actively protecting the legacy dollar while pushing digital innovation into the private sector.
We tore apart the granular details of the Tether USA stablecoin audit, exposing how liquidity crunches and microscopic surplus buffers can threaten a peg even under the watchful eye of a legacy auditor like Deloitte. We analyzed the philosophical compromise of platforms like OKX, abstracting away the friction of DeFi to chase mass adoption. And we looked at how Dubai is leveraging state-backed regulatory framework to tokenize real-world assets like real estate, injecting unprecedented liquidity into historically sluggish markets.
It is a profound amount of data, and it paints a picture of a financial ecosystem that is rapidly, messily evolving. Which leaves us with a final provocative thought for you to chew on. We've seen throughout this briefing how heavily the crypto industry is currently leaning on legacy institutions. They are utilizing traditional Big Four accounting firms like Deloitte to validate their stablecoins. They are relying on massive centralized exchanges like OKX to distribute their yields, and they are begging for state regulators like the Dubai Land Department to legitimize their tokenized assets. So the fundamental question is this: is the crypto movement actually conquering the traditional financial system, or is the traditional financial system quietly, methodically conquering crypto by wrapping it in its own centralized, highly regulated image?
That is the defining tension that will dictate the next decade of global finance.
And it is a transition we will undoubtedly be tracking closely. Thank you for joining us for this deep dive. We hope we helped connect the dots, cut through the noise, and gave you a sharper lens through which to view the chaos of the markets. Until next time, stay curious.